Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Fair Isaac was founded in 1956 by Bill Fair and Earl Isaac in San Jose. Their statistical model to predict consumer credit risk created the foundation of the modern consumer credit industry.
That model became the FICO score in 1987. It is now the de facto standard used by 90% of top U.S. lenders for mortgage, auto loan, and credit card origination decisions.
The regulatory moat is unusually deep. FICO scores are embedded directly in Fannie Mae, Freddie Mac, and FHA mortgage guidelines, requiring federal regulatory action to replace rather than just a better product.
The scores segment generates roughly $800 million annually. It charges lenders each time a FICO score is pulled in a credit origination decision, a scalable toll road model with high margins.
The software segment contributes around $750 million in annual revenue. It sells decision management platforms to banks, insurers, and telecoms, automating credit origination and fraud detection at scale.
Software margins run around 75%. The fraud and credit decisioning tools carry high switching costs as clients build deep operational workflows around the platform over many years of use and customization.
Operating margin runs near 45%, driven by the score segment mix. Each incremental score dollar earns nearly pure profit given the extremely low ongoing fixed cost of maintaining the underlying model.
CEO Will Lansing has run Fair Isaac since 2012. His 13-year tenure drove the strategic shift towards software and the aggressive pricing power strategy now deeply embedded in the mortgage origination channel.
Fair Isaac does not pay a meaningful dividend. Capital is returned entirely through buybacks, with the share count declining over 60% in a decade through consistent programmatic repurchase execution over time.
The 2022 FICO 10T model uses trended payment history rather than a single point-in-time snapshot, improving predictive accuracy. Broader Fannie Mae and Freddie Mac adoption would expand mortgage scoring usage significantly.
VantageScore, jointly developed by the three major credit bureaus, has gained real traction in credit card lending decisions and represents the most credible competitive challenge to FICO scoring dominance in consumer credit.
The long-term risk is regulatory disruption. If Congress or the CFPB mandates alternative scoring models to expand credit access for thin-file borrowers, it could gradually erode FICO's entrenched mortgage origination position.
For now, the regulatory moat holds firmly, and pricing power has proven remarkably durable across multiple interest rate environments. The software segment adds growing recurring revenue alongside the entrenched scoring franchise.
For technology investors, Fair Isaac is a rare combination. A monopoly-like data asset embedded in federal mortgage regulation, expanding software revenue, and a consistent buyback program that has reduced the outstanding float.
That's the company chapter for Fair Isaac. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
What does it cost to know whether someone is creditworthy? For lenders writing mortgages guaranteed by Fannie Mae or Freddie Mac, the answer is whatever Fair Isaac Corporation decides to charge. FICO holds a regulatory mandate that is essentially unique in American finance. The government-sponsored enterprises are required to use FICO scores, and FICO has exploited that mandate to raise prices over 400% since 2018. The result is one of the most powerful pricing moats in the entire technology sector. Today, we are breaking down FICO's first quarter 2026 results, which delivered a stunning 13.3% earnings beat above consensus, the software platform's accelerating growth trajectory, and the valuation debate around a stock trading above $1,800 a share. The bull case is compelling. The bear case is equally real. I am Hudson, and Lana is going to take us deep into the numbers. Let us get started.
Thanks, Hudson. Fair Isaac Corporation, ticker FICO, is the company behind the FICO score, the three-digit credit score used by over 90% of top U.S. lenders to evaluate borrower creditworthiness. The FICO score is embedded in virtually every mortgage, auto loan, and credit card decision in the United States, and it has been for decades. But FICO is not just a data company. Its software segment, including the Falcon fraud detection platform and the decision management suite, has evolved into a high-growth enterprise software business with multi-year subscription contracts at major financial institutions globally. Falcon alone processes billions of transactions daily, identifying fraud patterns in real time at some of the world's largest banks. FICO's business model benefits from both the recurring royalty stream of the scores segment and the growing software revenue base, creating a durable, two-engine growth machine that has compounded earnings per share at an extraordinary rate over the past decade.
First quarter 2026 results were outstanding by any measure. FICO reported earnings per share of $12.50 against a consensus estimate of $11.03, a beat of $1.47, or 13.3% above expectations. Revenue came in at $630 million. The scores segment performed strongly as mortgage application volumes showed improvement and price increases continued flowing through at high margin. The software segment posted organic growth above 20% as new Falcon deals closed and existing clients expanded decision management suite usage. Management raised full-year guidance after the quarter, citing software momentum and continued pricing execution in scores. The buyback program also meaningfully reduced share count, amplifying earnings per share growth beyond what revenue alone would explain. This was a high-quality beat with broad-based outperformance, not a one-line accounting quirk.
On the income statement, FICO's revenue of $630 million reflects the two-segment structure. The scores segment, which is higher margin and more cyclically subject auto volumes, and the software segment, which is recurring and growing. Gross margins at FICO are exceptional. Software gross margins approach 90%, and the scores segment operates at similarly high margins given minimal variable cost once the score infrastructure is built. Operating margins benefit from operating leverage as software revenue scales against a largely fixed cost base. Research and development investment has been increasing as FICO integrates AI and machine learning into its fraud detection and decision management products, a necessary investment to keep Falcon competitive. Net income and earnings per share growth have outpaced revenue growth substantially in recent years because of aggressive share repurchases. FICO has reduced its share count by over 30% in the past decade, a compounding tailwind for per-share metrics.
FICO's moat is among the strongest we cover on this show. In the scores segment, the moat is explicitly regulatory. Fannie Mae and Freddie Mac are required by their governing framework to use FICO scores in mortgage underwriting. That mandate gives FICO virtually no competitive pressure in the mortgage channel. Lenders cannot switch even if they wanted to, because the GSEs set the standard. FICO has exploited this position to raise royalty prices dramatically, from around $3.50 per score in 2018 to over $15 today, a 400% plus increase with minimal customer attrition because the customer has no practical alternative. In the software segment, the moat is switching costs and deep integration. Falcon is embedded in fraud operations at hundreds of institutions globally. Replacing it would require years of integration work and carries enormous operational risk. The combination of regulatory mandate and switching cost protection is as durable as competitive moats get anywhere in the technology sector.
Cash flow generation at FICO is exceptional and reflects the asset-light nature of the business. The company requires no manufacturing, carries no inventory, and has minimal capital expenditure needs, allowing it to convert a very high share of net income directly to free cash flow. That free cash flow has been deployed almost entirely into share repurchases, which is the defining feature of FICO's capital allocation philosophy over the past decade. Management has shown no interest in paying a dividend. Instead, every excess dollar goes back to buying shares. The share count has fallen from roughly 30 million to roughly 20 million over the past decade, and repurchases continue at current elevated prices. At a stock price above $1,800, and a market cap around $24 billion, each buyback tranche is a significant management bet that the business is worth more than the current price. And so far, that bet has been correct year after year.
Capital returns at FICO are entirely buyback-driven. There is no dividend, and management has consistently communicated that buybacks are the preferred return vehicle because of tax efficiency and the flexibility they provide versus a fixed dividend commitment. The buyback program has been aggressive and sustained. FICO typically repurchases $1 to $2 billion of stock per year, which at a $24 billion market cap represents 4 to 8% of shares outstanding annually. That pace of repurchase, sustained over years, creates a meaningful and compounding per-share tailwind. Combined with operating earnings growth in the mid to high teens organically, FICO has delivered earnings per share growth well above revenue growth, which is the primary reason the stock has compounded so dramatically over the past decade. For investors who prefer dividends, this is the wrong stock. For investors who appreciate the mathematical power of sustained buybacks at a high-quality compounding business, FICO is the textbook case study.
Several catalysts support continued FICO outperformance over the next few years. First, mortgage market recovery. FICO score volumes are directly tied to mortgage application activity, which has been suppressed by elevated interest rates. Any meaningful decline in rates would drive a surge in refinancing and purchase activity, boosting scores revenue substantially, and FICO would capture that volume at today's elevated per-score pricing, making it a high-margin windfall. Second, software segment expansion. The Decision Management Suite is gaining traction as financial institutions modernize their decisioning infrastructure and require multi-year enterprise contracts. Third, international scores growth. FICO is expanding its scoring model into new markets outside the United States, potentially replicating its domestic regulatory mandate model in additional jurisdictions. Fourth, AI-enhanced fraud detection. Falcon's machine learning integration is expanding FICO's addressable market into broader cybersecurity and identity verification adjacencies, opening new revenue streams.
Analyst sentiment on FICO is broadly positive, with a buy consensus and a price target of approximately $2,016 against a current price near $1,800. That implies upside of roughly 12% from current levels, which is somewhat modest for a consensus buy rating, reflecting the view that much of the obvious upside has already been captured as the stock re-rated dramatically over the past several years. Bulls are comfortable holding through a premium valuation because of the consistency of execution and the earnings per share momentum the buyback program provides. A handful of analysts have raised concerns about the multiple. 60-plus times earnings is a premium that leaves little margin for error if anything goes wrong. But the majority remain constructive because the business has consistently delivered upside to estimates, as Q1 2026's 13.3% beat powerfully demonstrates once again. The consensus reflects genuine respect for the franchise.
Valuation is the most contested debate in the FICO investment case. At roughly 60 times trailing earnings and above $1,800 per share, FICO carries one of the richest multiples in the software universe. Bulls argue that the multiple is justified by the combination of extraordinary pricing power, a regulatory moat, software growth above 20%, and aggressive buybacks that continuously shrink the share count. Bears counter that 60 times earnings is a multiple requiring perfect execution, and it leaves the stock deeply vulnerable to any earnings disappointment. On a free cash flow basis, FICO trades at a premium to most enterprise software peers, though the comparison is complicated by the buyback intensity, reducing the share count denominator meaningfully each year. If you believe the scores segment sustains elevated pricing and software continues growing, the stock looks rationally valued. If either assumption proves wrong, the multiple compression can be painful and swift.
Bull case number 1. Mortgage market recovery is an underappreciated earnings accelerant hiding in plain sight. FICO score volumes have been running below historical norms because elevated mortgage rates have suppressed both purchase and refinancing activity across the United States for multiple years. When rates eventually normalize, whether in 2026 or in the quarters beyond, Pent-up refinancing demand could drive a sharp surge in score volumes that flows directly to FICO's revenue at today's elevated per-score pricing. The combination of higher volume and higher price per score is a powerful earnings multiplier that no other business in the financial data space can match. In prior rate normalization cycles, mortgage score volumes have recovered quickly and dramatically once housing affordability improves. FICO shareholders who hold through the rate suppression period are positioned to benefit from that recovery without any change in FICO's competitive position or pricing.
Bull case number 2. The software segment is approaching an inflection point that could re-rate the stock higher even from current premium levels. FICO's Decision Management Suite and Falcon platform are at a point where multi-year contract renewals and client expansions are compounding on a meaningful installed base across hundreds of global financial institutions. Software revenue growing above 20% organically at 90% gross margins creates compounding earnings power. Critically, as software becomes a larger share of total FICO revenue, the business mix shifts toward more predictable, recurring revenue, which the market typically values at a higher multiple than transaction-based scores revenue that fluctuates with mortgage volumes. If software reaches 50% of total revenue within a few years, the market may re-rate FICO closer to pure-play enterprise software peers, implying additional upside even from the current elevated multiple. The software ramp is the thesis that transcends any mortgage rate cycle.
Bull case number 3. The buyback program at this scale is a per-share compounding machine that most investors underestimate. FICO has reduced its share count from roughly 30 million to roughly 20 million over the past decade, a decline of over 30% accomplished entirely through capital returned to shareholders. At the current buyback pace, the share count could fall below 15 million within the next few years. Every dollar of operating earnings is then spread across an even smaller denominator, mechanically accelerating earnings per share growth beyond what revenue growth alone would produce. This dynamic means FICO can deliver double-digit earnings per share growth even in years where revenue growth moderates or softens. For long-term holders, the effect is a quiet, self-reinforcing ownership expansion. Your percentage of the total business grows every quarter without buying a single additional share. The math is compelling over any multi-year horizon.
Bear case number 1. Regulatory risk at the GSEs could structurally disrupt the moat that underpins the entire bull thesis. The Federal Housing Finance Agency has been exploring for several years whether Fannie Mae and Freddie Mac should accept alternative credit scoring models, specifically VantageScore, which is owned by the major credit bureaus. If FHFA formally requires or allows GSE acceptance of VantageScore alongside FICO, it would introduce real competitive pressure into the one market FICO has historically treated as a captive, price-insensitive monopoly. FICO management has consistently disputed the severity of this risk, arguing the score is too deeply embedded in lender workflows to displace quickly. But the regulatory overhang is real and persistent, and news of any FHFA action tends to move the stock sharply lower. This is not a risk that resolves cleanly. It is a multi-year regulatory process that will resurface repeatedly as a headline risk for shareholders.
Bear case number 2. A valuation at 60+ times earnings is structurally unforgiving and punishes any negative surprise. FICO has delivered exceptional results quarter after quarter for years, but the 60 times earnings multiple means investors are paying today for multiple years of future growth that has not yet materialized. If software growth decelerates from 20% to 15%, or if mortgage volumes recover more slowly than expected, or if a price-fixing lawsuit from lenders reaches an adverse outcome, the earnings disappointment could trigger significant multiple compression. At 60 times earnings, a 10% shortfall combined with a modest multiple compression from 60 to 50 times would translate to a 25% stock decline. The asymmetry is stark. Modest additional upside on another beat, significant downside on any miss. Lenders have filed price-fixing suits challenging FICO's score pricing practices, adding a litigation overhang that is genuinely difficult to quantify but impossible to responsibly ignore.
Bottom line on FICO. This is one of the highest quality businesses in the market, a regulatory mandated moat in scores, a high-growth software platform scaling toward 50% of revenue, exceptional free cash flow conversion, and a buyback program that has compounded per-share value for a full decade. The Q1 2026 beat of 13.3% on earnings is not an anomaly. It reflects consistent execution against a franchise that earns more per unit of output every single year. The bear cases are real. Regulatory risk at the GSEs and a 60-plus times multiple are genuine concerns, but they have been real for years without derailing the earnings trajectory. At $1,800 with a consensus target of 2016, the near-term price upside is moderate, but the long-term compounder case for patient investors is firmly intact. This is not a stock you buy for a quick trade. It is a stock you buy because the moat deepens every year and the share count falls every quarter. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.